when inflation is at 3% already, because you stimulate at 3%, we go to 12%, 15% inflation off of the same type of money printing that they did in 2020 through 2021. So in other words, it's most likely the mere fact that you're going to see the economy really stutter. I think you get into a recession in the second half. In fact, the Fed basically said that just a week ago. Interestingly enough, the stock market has ignored it. Risk assets have ignored that. But again, the Fed is telling us exactly what they're expecting. And I always look at it like it's going to be worse. If the Fed says something, always think 3 steps worse than what the Fed is telling us.
Gareth Soloway, who serves as the chief strategist of InTheMoneyStocks.com and as the president of Verified Investing Education, points out that Bitcoin is currently hovering just below a crucial technical threshold of 30,500. This level represents a psychological hurdle and a critical turning point that could indicate whether the bear market's low point has been reached. Soloway believes that while Bitcoin's recent rally may appear to be a bear market rally, there are still more risks and uncertainties that could impact the broader risk asset market. Soloway highlights several factors that could negatively impact the market in the near future, including the Federal Reserve's warning of a possible recession and the continued regulation of cryptocurrencies by the SEC. However, he notes that gold has been performing well and could be a viable asset for investors to consider. Despite his warning about the market's potential vulnerability, Soloway believes that the market is not fully heeding the Fed's warnings about a possible recession, which could lead to dire consequences if the market is caught off guard. In his view, such a scenario could be catastrophic, and investors should be cautious and vigilant. In the video, Soloway shares his insights on these issues and offers his thoughts on how investors can navigate the market's current challenges.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So as of now, anyways, Bitcoin remains just underneath a major technical level, this 30,500 level. We've hammered on it. We can see, in fact, on the chart right here, lots of resistance. We've tried to push above it. Each time we're failing, at least at this point. Yesterday, we pulled back pretty sharply and then rallied back today as there's kind of a risk-on attitude back in the market. But the bottom line is this 30,500 level. Number one, it's an even number. So it's anytime you get above a 30,000 or a 40, there's always going to be a tendency to get kind of the last people in the trade, which weirdly enough is not the best thing, because once you get those last people in, you don't have a lot of new buyers. And so I think that's what's happening here with crypto. We're into this level where if we zoom out, this was the low from the 2021 bull market cycle. And it was also the low right here. And we've basically done a round trip. And I know I have a lot of lines on the chart, but we've done a round trip from that breakdown, which occurred in June of 2022, all the way back to where we are right now. So again, if we look back here, and again, this area here to here, that's where we're hammering on right now. And to me, that's a huge psychological level. And it's also a level where it will pivot me into thinking that the low is in. If we successfully hold above 30,500 for multiple days, I'm really looking for 5 to 7 days, then to me, you probably do have a low on Bitcoin in. As of now, I'm not convinced of it. I still think this is a bear market rally. I still think there's more shoes to drop in the risk asset market. The bear market of 2017, well, 2018, 2019. I mean, we had rallies from 3,500 all the way back to 10,000 and then back to 3,500. So you've had these bounces in Bitcoin that have actually even been bigger than what we're seeing here. We're just up around 100% or just under 100% versus back then it was 200%. So I think we have to keep that in mind. I also think that if you look at what the Fed has said, you have to be very careful here. So we do know that the SEC continues to sue and kind of put down regulation, or the beginning structure of regulation in crypto. And then the Federal Reserve just came out recently and said, hey guys, we expect a slight recession. And if you're anyone like me and you hear slight and the Fed saying slight and they said transitory and we saw what happened, you have to be nervous about risk assets in the future. And that's where I am. I honestly think that stock market's getting ready to have a second half that is going to be atrocious. And my guess is it drags down crypto as well. 10-year chart has this trend line here that we've bounced off of. My guess is we're headed back down there by the second half of this year. That would be around 3% on the 10-year. So I actually think there's further downside on the 10-year. Another ETF that's a great way to follow it is when yields go down, the TLT tends to go up. It's kind of an inverse ETF here. And you have this beautiful sideways channel of bullish consolidation, which eventually tells me that the TLT will move up, which tells me yields go down. The only way yields are going down is if we do get a recession or at least a slowing economy that's significant, which then basically makes the Fed potentially have to start backing off their rate hikes in the second half. Yeah, they said to expect last week, they said to expect a minor recession. A minor recession, or I don't know what the term was, but it was basically like, oh, just a tiny recession. But again, if you're like me, and I said this at the beginning, remember they were like, oh yeah, we'll have inflation, but it's transitory. So it's one of those scenarios where, to me, they always try to sugarcoat because they don't want to scare the markets and cause a collapse. But smart investors have to start prepping for a worse recession than what they're saying. And again, that's just risk management.
Soloway has noticed that the market has a remarkable ability to overlook warning signs of an impending recession, such as Warren Buffett's recent comments on CNBC regarding his retailers' performance. In terms of indicators, Soloway believes that a recession is looming due to a significant slowdown in the economy, which will prompt the Fed to back off from raising rates and eventually lead to a drop in yields. He also mentioned Goldman Sachs' recent missed earnings report and discussed the ongoing banking crisis, noting that while Jamie Dimon has warned that it's not over, the market appears to be disregarding his cautions. In the following video, Soloway discusses the various indicators of an impending recession, as well as the market's complacency in responding to the Fed's warnings and the possibility of a new banking crisis.
I've been inching into shorts. And again, I'm one of those type of people that as a trader, I've learned my lessons in the past. So I inch into positions. I don't go all in. So I've just been inching in one toe at a time in the water here on the short side of the market, a little bit of the Qs short, a little S&P short, and kind of just preparing for what I think is coming. And I also think going into earnings season, I mean, we're basically just starting earnings season now. There's going to be a lot of negative revisions, in my opinion, or lowered forecasts. And that's the market, to me, is not prepared for that. If you look at like the forward PE of Microsoft, the forward PE of Apple, there's no preparation for any type of recession in that valuation. And that will have to reset at some point when the market comes to that realization that the Fed is telling the truth, that there will be a recession. The markets don't care until they care, right? So last week on CNBC, I happened to catch Warren Buffett saying that he has a retailer that he owns, right, and that Berkshire Hathaway owns. Year over year, their sales of this retailer were down 22% year over year. So to me, that was a shocking statement. I mean, that is a massive decline in revenue, and the market again ignored it. Nothing big, nothing to see here, essentially. So those type of things I'm picking up when you have big players that know what they're talking, the David Teppers, the Warren Buffetts, these big name hedge funds that you have respect for because they're accurate. That's what I pick up on out there. This is the psychology of the market chart, right? So basically you have this run up. And to me, this run up that we've seen looked very much like the run that we saw from COVID all the way up to 2021. We then had this sharp decline here. Now, look at the price action that we're seeing here in this psychology of the market chart. It's a lot of sideways to slightly up. Now, if I flip back to my S&P chart, okay, let's go back to this chart, and I want to go to my weekly chart. Look at what we've done here, okay? You have the same sort of sharp move up, getting to euphoria, the sharp move down. There's even this little pivot where we had a lower low, and then sideways consolidation. And so again, if you look at this down move and this choppiness, this is exactly the part within the psychology of the market that is going to tell us that this is the next down move to go. And just to reiterate, I want to switch back to that chart. Just remember what we just saw right there. And that's this part. We're right in the midst of this complacency period where people are saying, oh, it's, the bull market was so great. I want to revisit that. It's going to come back. I really hope it comes back. Let's just sit and wait here. And that's what leads us to this next period of downside via psychology of the market chart. So amazing how accurate and how the chart of the S&P 500 here follows this to a T, the complacency chart portion. Look at the crypto markets right now. They're as bullish in the crypto markets as we were when we were at 69,000. That's how quickly we've got back. That's complacency. They're basically saying, hey, listen, we're going back to all-time highs. To me, that's a red flashing warning sign out there to be very careful in this market. So another example of the markets ignoring what he's saying, right? So again, you have Jamie Dimon, who runs basically one of the biggest banks in the world, and he's telling you this is not over, yet the markets are like, it's over, no big deal, let's keep buying the S&P 500. All right, if this is over, why is the KRE, which is the regional banking ETF, having literally no bounce here? I mean, this is, to me, a classic case of a bearish chart pattern, and that's got to be very concerning, the fact that the regionals still are not getting a bounce, especially when the Fed basically came out and said, hey, or the government said, hey, we'll make sure that depositors don't lose money, all these things. You even got a bunch of the big banks to put a ton of money in FRC, and here we are. The banking ETF for the regionals is basically at its lows. So there are things cooking here that, to be honest, right now, I would be shocked if we have not dropped significantly within the next 3 months in this stock market, in the S&P, in the NASDAQ.
Gareth Soloway expresses skepticism about the current phase of the market and argues that investors have become conditioned to believe that the government and Federal Reserve will always come to their rescue. However, he believes that the market may not receive the same level of bailouts as before because inflation is currently below 2%. Soloway predicts an upcoming recession and suggests that the market is not adequately prepared for it. Soloway expects a decline of approximately 3,300 on the S&P 500 by the end of the year and 3,000 in early 2024. He also believes that the market will eventually retest the lows it experienced in the past. The minutes from the March 21st and 22nd meeting revealed that policymakers, for the first time, predicted a mild recession in the U.S. starting later this year. Some members of the Federal Open Market Committee considered freezing interest rates in response to the turmoil in the banking sector. While some policymakers argued for a pause and rate rises to assess the impact of bank collapses on credit conditions in the U.S. economy, ultimately, the FOMC decided to go ahead with a quarter-point rise to a new target range of 4.75% to 5%. However, the release of the minutes led to a 0.4% drop in the benchmark S&P 500 and a 0.9% decline in the tech-heavy NASDAQ composite. Futures trading today indicates a slight increase when trading resumes later. The Consumer Price Index shows a 5% rise last month, compared to 6% in February, according to the Bureau of Labor Statistics. However, core inflation, which excludes volatile food and energy costs, rose 5.6% year-on-year in March, indicating that prices in certain parts of the economy remain elevated. In light of these developments, the question remains whether the market is truly complacent, or whether the situation is not as bearish as it may seem. Please share your thoughts in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.